The opinions expressed on this program represent the viewpoints of individual authors or contributors and do not necessarily reflect those of Troy University. This is EconVersations, a joint production of Troy Trojan Vision and the Manuel Johnson Center for Political Economy. Now, here's your host, Dr. Dan Sutter.
Hello and welcome to EconVersations. I'm your host, Dr. Dan Sutter of the Johnson Center for Political Economy at Troy University. ESG investing has gone in the span of about 3 years from a relatively obscure investment topic to a significant political issue, with state legislatures even taking up bills related to this question. What does ESG involve? And more importantly, perhaps, in light of all the attention now being paid to it, does it represent a market and thereby, by implication, voluntary phenomenon? An examination of whether ESG is truly libertarian is critical in light of critics labeling ESG as socialism or central planning, and defenders of ESG claiming to be defending free markets. How should we evaluate ESG? Joining me on the show today to discuss this topic is Dr. Alan Mendenhall. He's the Grady Rozier Professor and Executive Director of the Johnson Center. Dr. Mendenhall earned an undergraduate degree from Furman, a law degree from West Virginia University, and a PhD in English from Auburn. He's been with Troy since 2020 and has become one of the leading critics and scholars on ESG. Welcome back to the show, Alan.
Thank you, Dr. Sutter. It's a pleasure to be here.
And so before we get started here, we're going to be talking about some research that we've done. We just have gotten a paper accepted examining this topic. So just wanted to let, and where is that going to come out?
It's one of Emory's law journals, the Emory Journal of Law and Corporate Governance.
And so let's get started here, and we'll get into this question about whether ESG is truly a market or voluntary phenomenon. But first, let's start by reminding, because we've had a couple of shows about ESG before, but remind everybody first what exactly ESG stands for and what's involved with that.
Well, the acronym ESG stands for Environmental, Social, and Governance. And what that refers to are the non-financial standards and factors that banks, financial institutions, and institutional investors, among others, account for when they allocate capital or assess risk.
Mm-hmm. And there's actually two ways we can sort of view this. We can talk about ESG from an investing standpoint, and then ESG as corporate governance. And although they're clearly related in the same ES and G, there's a slightly different interpretation there that I think we want to be clear of, because we'll be referring to both of these different ideas.
Yeah, so in the former, when you're talking about what company management and boards do internally, how they integrate ESG factors into their corporate structure, their policies and practices, whereas ESG investment refers to what asset managers and institutional investors, or individual investors as well, do when they invest money or when they construct portfolios. And this evaluates companies not just on financial performance, but based on their ESG metrics. So it involves screening, choosing or excluding companies based on ESG performance. It involves active engagement, shareholders influencing corporate policies to align with ESG goals, and impact investing, which is targeting investments that yield measurable ESG benefits, allegedly benefits, alongside financial returns.
Now, as an investor, if you or I don't have any money to invest, but if anybody who has some money to invest, should they be okay? Should they be allowed to go out and try to use their money to make the world a better place, as opposed to just trying to make a big return for themselves, or try to make the most money they can?
Yeah, there are no legal or ethical issues or moral issues with somebody investing his or her money as he or she wishes. Voluntary investment is perfectly okay.
Okay, so we were actually, in this research, we were responding to a paper that had been written by, I think it's a Yale law professor named Jonathan Macy, who made the argument that ESG is libertarian. So tell us briefly a little bit what his argument was there.
Yeah, I think what he is trying to show is that government has failed in many areas many times over many years, and that this turn toward private corporations represents a libertarian movement. I believe he's wrong, and we can maybe talk about that. But I guess the general framework for his paper is that, okay, we have all this government failure, and now we need to turn to the private sector to fix things.
Mm-hmm. Yeah, and he even refers to, like, corporations have become to be viewed as organizations that can get things done, whereas government can't. And then also maintaining the idea that because this is operating through markets as opposed to government mandates and coercion, that somehow this would be a more libertarian or voluntary way to address questions like climate change or gender equity or topics like that, right?
I think that's a fair representation of his argument, yes.
So let's get in. We took issue with this, and so let's step through some of the points that we wanted to make in response to it. Starting with the fact that they're now, depending on different measures, trillions of dollars literally being invested in, quote, ESG investing of different types. Given that we said before, anybody's free to use their money however they want, whether they want to make it, try to make the world a better place, try to go for the best return possible, or if they might even be concerned about making a lot of money out of something that they thought was morally questionable, then what's the problem with all this money being in financial markets directed to ESG? I mean, is it just the fact that maybe finally Wall Street's growing a conscience and cares about something other than their profits?
Well, this is the critical piece, because we have projected 150 trillion assets under management as of 2025, which we're almost to. We're sitting here in December 2024. Well, according to Forbes, we have 2,781 billionaires in the world, accounting for a combined wealth of 14.2 trillion. That's nowhere near 150 trillion. In the United States, we only have 756 billionaires, only one here in the state of Alabama. So how do you get to $150 trillion of assets? Well, a lot of it is explained by the investment of government money, whether in the form of bonds, municipal bonds, other forms of bonds, but largely state and federal pension dollars and pension money of other foreign sovereigns, as well as sovereign wealth funds. These are all forms of government money that get invested. And when we're talking about government money is always derivative of taxpayers.
Okay. So let's start with pensions here. You mentioned pensions. And in theory, of course, especially when you have defined benefit pension plans, that you've got the pension plan or the fund is collecting the money that the members or contributors pay every month, or their employers pay into this fund, and then they're supposed to be investing that to get returns to be able to pay the promised benefits. So, and then particularly, then you have both those in the private sector and the public sector. So when we think about a public employees pension plan, and some of these are very prominent ones like in California and New York that have long histories of activism, let's get into this question. Is there really like informed consent, or are the members agreeing to what's going on here?
Yeah, that's a great question. You mentioned California. I think CalPERS manages something in the range of $503 billion in assets for over 2 million members. And so you're going to have a misalignment of incentives due to diversity of beneficiary interests. There's no way that you can invest money, that pension money, in a way that accounts for every beneficiary's individual interest. It's just not possible. And so then you get into fiduciary duty problems. Maybe there are some people out there who prefer to maximize social welfare by their investments and not financial returns. But then how do you go and measure the different degrees of social welfare and people's risk appetite for different degrees of socially based or socially responsible investing? It's not possible. The only criterion that you can actually use that would apply writ large in that way is the maximization of financial returns. It's really the only measure that can apply across the board fairly and non-politically, because another Another issue you get into is politicized decision-making due to the appointees of different trustees of these funds, and also the politicization of investments themselves. If you're investing in ESG-weighted portfolios, which ones do you choose? What companies have to get screened out? And once you start getting into that sort of nitty-gritty, you inevitably politicize the investment process.
No, as you mentioned, it's just some of this, especially when you have a pension plan like this, and it's inevitable. You or I or many people are going to be part of the same pension plan. Somebody's got to invest those assets in charge of it. And because the alternative would be we could have our own independent investment accounts. That's a defined contribution plan, IRAs. Right. And then with that, I think everybody could allocate their funds to whatever they want. But in these defined benefit plans, it truly is a plan, and the plan has to be investing somehow. But you raised a very good point. I mean, there could be liberals and conservatives, members of the same plan, and when they want to make the world a better place or invest in companies aligned with their values, they want to invest in completely different causes altogether.
Well, and typically the opt-out provisions are incredibly difficult to meet. Sometimes they're non-existent in places. And so let's say that you are just an elementary school teacher and you're a Christian conservative elementary school teacher. We'll just use this example because it's probably one that fits somebody in our state. And you find out that state pension money is being invested in ESG portfolios that include companies who are there because they provide abortion services to employees who want to go out of state to get an abortion because their company won't, because their state won't allow abortion in the state. Right. Well, you have obvious moral and personal objections to that policy of that company, and little did you know that you are indirectly subsidizing that company's policy. This creates a freedom of speech problem. After the Janus decision that the U.S. Supreme Court handed down a few years ago regarding mandatory union dues and how they could not be used because they would violate free speech to support causes with which the union members disagreed when the member's mandatory. So, for example, if I'm a member of the Alabama State Bar, as I am, it's problematic if my state bar dues were being used to support other sorts of political causes. Well, that logic, that reasoning, that rationale can be extended to this situation, and I believe they're genuine, real, and concerning First Amendment issues with these pension funds investing in ESG funds.
And then there's also perhaps the more there's another type of problem here. The members who simply would like their contributions to be invested in such a way to make sure that they have those retirement benefits that they're counting on. They're planning to work their 30 years or 25 years and retire with these pension benefits. And if the pension fund uses all of their money trying to make the world a better place and then say, well, we invested in all of these solar companies and they went bankrupt, we don't have any money to pay your benefits, then you've got another very significant problem.
Unfunded liabilities is a problem even before ESG, and it's even more of a problem after ESG. And you'll see some companies trying to institute things like pass-through voting or an informed intermediation model where they try to solicit input from the members before the investments occur, or they take proactive steps to try to understand beneficiary preferences. But there are key problems here. Number one is there's low voter turnout, there's low participation rate with those measures. But also, those measures are limited to a narrow range of options predetermined by the advisory firms. It's not truly the beneficiaries getting free agency to select from whatever menu of options they desire. It's a very small menu selected by the advisory firm, and so in essence, there's not truly free choice for the beneficiaries.
And then, since some of these plans are also state programs, I believe it's 40 or 41 states actually guarantee the benefits of members by either the state law or even their state constitutions. If the pension fund at some point in the future doesn't have the money to pay the promised benefits, taxpayers are on the hook.
That's exactly
And so in
right.
effect, ultimately, the pension managers trying to make the world a better place, if they fail in that, they're actually putting the additional taxpayer money. Taxpayers have already paid, in effect, as part of the salaries. That you could think of the pension as part of the compensation for the employees, so they already paid for it there. And then if you don't get the expected returns, taxpayers are on the hook again.
That's exactly right. Yeah, you've extracted a bunch of wealth from the people of your state and basically flushed it away.
You mentioned the term sovereign wealth fund, and that's also where a lot of this globally assets come on. Mention what that is, because there's actually been some talk about maybe should the United States try to create a sovereign wealth. Tell us a little about these.
Yeah, these are government-owned investment funds. They're common in oil-rich nations like Norway or like many of the Middle Eastern countries, and they're sometimes derived from commodity profits or currency reserves. But they invest in they invest in things like whether stocks, bonds. And also basically exchange-traded funds is what is really we're seeing because of the rise in passive investment since the 80s. We see a lot of the sovereign wealth fund money being put into the ETFs, and some of these ETFs are ESG friendly.
Mm-hmm. And then let's get into another part of it. Another element of it is these index funds or these managed funds. And there's two issues that arise here. There are some of these funds that are explicitly labeled as ESG investment funds.
That's right.
And then there are other things that are like S&P 500 funds. They're supposed to simply be investing in S&P 500 firms. And what are the issues involved here?
Well, an ETF that tracks the S&P 500 is typically going to perform well over time, just because generally the market performs well over time. But I guess the issue with passive investment that becomes problematic is when you are investing other people's money. Again, we're talking about asset management firms getting very wealthy off of the investment of government money, firms like BlackRock, State Street, and Vanguard. Now, when they gain that wealth, what they then do is they engage corporations. They go out and buy shares of companies. So they're the leading stockholders of most companies that are publicly traded. So they are, interestingly enough, they may be the largest shareholder in direct competitor companies. Right. Or what they typically did historically was they bought shares of companies that were investing in infrastructure and that were most likely to get government subsidies. So they were taking government money on the front end, investing it, and then investing it in companies that were getting government subsidies on the back end. And that's just basically a giant wealth extraction from taxpayer business model, where you're just siphoning out government money on both ends, and that's what your whole business model is predicated on.
And then the issue arises if you've got one of these non-explicitly ESG funds. It's just an S&P 500 fund.
The greenwashing.
And then using the money, using in effect the leverage that comes because we own 20 or 25% of the stock in your company, because these index funds are so popular now, and they really are a very good investment.
Yeah.
To use that fund, which again, the investors didn't put that money in there explicitly to pressure companies to do ESG. But when BlackRock is talking to companies saying, we have all this money, we own all of your stock, we're going to force you to try to do, or convince you to do things that aren't going to help your bottom line.
Yeah, and that's the whole reason the SEC instituted its new names rule, which requires 80% of the securities in a portfolio to match how they're advertised as being. So if they're advertised as being ESG, 80%. If a fund is advertised as being ESG, 80% of the securities in that portfolio actually have to be ESG related, and part of that's because ESG-weighted portfolios did pretty well during the pandemic, but it turns out, they weren't ESG at all. This is what we call greenwashing or woke washing, where companies are the funds advertise themselves as being sustainable or socially responsible or whatever the term may be, when in reality, they just have every single company that any other portfolio has. They're just virtually interchangeable, and that's why the reason they did well is because all they really did was track the S&P 500. They weren't actually ESG.
Yeah. So we've talked a lot about the investing part of it, but there's also a lot of government regulations and laws and mandates, and not just in the United States, but globally. And in fact, this is too big of a topic to get into, but
it is.
Let's talk a little bit about some of these laws that are sort of pushing the market to ESG.
Well, there's a sort of a macro and a micro version. The macro version, ESG derives from, it predates this, but it really was articulated the first time at the Who Cares Wins conference, which was sponsored by the United Nations and the government of Switzerland. Of course, the United Nations gets roughly 3/4 of its funding from government, and it's a very government-driven phenomenon, whether you're talking about U.S. tax credits for clean energy or stricter emission standards, or whether you're talking about the European Union's Green New Deal and climate law. Over 60 jurisdictions across the world require ESG data disclosures. We now have new SEC disclosure mandates coming down the pipeline. We also have a new Department of Labor regulation that is ESG related. And the heavy regulation predates ESG, but it is expanded with both climate and diversity initiatives. I think we see, for example, even stock exchanges adopting new regulations. If you want to be traded on NASDAQ, for example, now you have to disclose this diversity stuff. And what's really interesting is how costly all these disclosures are. Writ large across the economy, they could cost us billions of dollars just to produce information that is already publicly available, that investors can already find out there. So they're just sort of reproducing data that exists, and that's just wasteful.
It turns out that even before the government acts, the prospect of government action can sometimes lead people in the market to take action, and this makes it even harder to draw a clear line. This is government, this is voluntary. Long before government acts, people might be looking to change their investments, right?
Yeah, well, two things about investments. They're about maximizing returns and mitigating risk. Well, a lot of the proponents of ESG focus on that second part, mitigating risk, and one of the risks they talk about is regulatory risk. Right. You need to be, you need to worry about regulatory risk. Meanwhile, they're spending a ton of money lobbying for the very regulations that they're warning against. So it's a self-fulfilling prophecy in that respect. They want the regulations to come down the pipeline. And essentially ESG, if you think about it this way, if you narrow the range, so if diversification is what minimizes risk, because you're able to spread your assets across different industries against different fields, and that way if there's a downturn in one area, well, you're protected by upticks in the other area. Well, ESG narrows the range of possibility. Mathematically, over time, it's not possible for it to succeed against somebody that doesn't have that has more diversification. But what the people that advocate ESG therefore want to do to make ESG work is institute more regulations. They want to change the rules of the game because ESG only works if everybody has to play by those rules.
Right. So just to be clear about this, what we're talking about here is that you wouldn't want to be the owner of a coal mine, for instance, the day that the government decides that they're going to ban coal. When financial markets are forward-looking, you're going to want to take that into account, and you're going to want to get out of that investment before the government comes along. And this makes it really difficult for us to tell if this is voluntary or not. And so you'd see companies moving out of, say, fossil fuels investments, disfavor things, into the politically favored things before necessarily laws come into place. And so it's not completely voluntary.
And you saw something like that happen with even the state of Maine, for example, divesting from fossil fuels. And that's also problematic because of the high degree of returns historically that such an industry yielded.
So we think that this topic is this interpretation of ESG is important because we have seen an anti-ESG movement show up, even in terms of some anti-ESG bills taken on by different states. It's become a politically contentious issue. Vivek Ramaswamy, who's going to be in the President Trump Department of Government Efficiency, really sort of came to prominence by touting some of the problems of ESG. It's really important in terms of trying to think about what's going on with the anti-ESG market movement as to whether or not you see ESG as primarily a market-based voluntary phenomenon or if it's a government-driven phenomenon, right?
Correct. Yeah, if ESG does not rely on voluntary market-driven choices, then its implementation through mandates and government intervention and coercive pressures undermines individual freedom and the free market. In that case, it lacks moral justification and should not be instituted because it imposes collective goals at the expense of personal choice and market autonomy. And I think that's a broad philosophical statement that is profoundly true.
And then this is also important because we've certainly seen some of the major financial institutions pulling back a little bit from ESG. I think it was Vanguard dropped out of the Net Zero Asset Managers Coalition. The CEO of BlackRock has disavowed ESG publicly. And then related to that, especially after the recent 2024 presidential election, we've seen some people talk about, oh, we're past peak wokeness in society generally. Is it possible that ESG is going away on its own and that we might be beating, if not quite a dead horse here, one that's clearly on its last legs and going out anyway? Or is this still an important issue to engage on?
I think that it remains highly relevant despite the apparent retreat. Yes, there are some successes that the anti-ESG movement can claim, but there is also a large degree of rebranding that's taking place. It's taking the taxonomies of ESG and altering them so that instead of saying we've got an ESG portfolio, we've got a socially responsible investment. Something like that is occurring. The pushback against ESG does, I think, highlight the need to reaffirm the moral value of profit making within the bounds of the law and the importance of respecting the voluntary, complex nature of business. Businesses are specific entities. They're with a legal purpose, and that is to maximize profits for shareholders. And too often people think about profit maximization as a bad thing without fully understanding what it is that a firm exists to do. There are vehicles for charity, there are vehicles for philanthropy, and those are perfectly suitable ways for people to reallocate wealth or to give and do things that we now call socially responsible. But when you use the corporate structure, when you use the corporation to try to do that, I believe you're either being disingenuous, you're trying to basically trick people into thinking we're doing all this good stuff. It's just a marketing ploy. The greenwashing. The greenwashing thing, right? Or you're doing things under regulatory pressure, other forms of coercion through sort of the BlackRock, State Street, Vanguard shareholder engagement, and other other things of that variety.
Yeah, and I certainly think, as you mentioned, I think reaffirming or affirming, because I think that the folks who think that business doesn't really have a right to exist unless it advances larger social purposes or becomes a tool of social engineering, I think that they have a lot of sway. There are a lot of folks out there that think that way, who think that investment should be, financial markets really should be a tool of social engineering and advance people's preferred causes. And it ignores or forgets the whole point that these businesses are massive organizations, and they're all voluntary.
And they create jobs, they provide goods and services, they thrive because they serve the needs of owners, employees, customers, communities through mutual agreement and benefit. And when you impose ESG externally, you risk distorting this dynamic by turning private organizations into tools for advancing specific agendas.
Well, thanks so much for coming on and talking about this. And thank you all for joining us. Join us again next time for another EconVersations.
This has been EconVersations, a joint production of Troy Trojan Vision and the Manuel Johnson Center for Political Economy at Troy University.